trying to do this reverse collar where we bought the stock at 30.23, bought the near-term 3rd of February, about a week out, 30 put at $1. And even going out to March, the 31 call was about 80 cents, the 32 call was 60, the 30.50 was close to that, but that didn't give us a lot of upside on the position. So again, we would have paid 30.63 out of pocket just because of a little bit extra, 4% risk, 4.3% max return, which you could have gotten, by the way, on a standard collar just on March 3rd. If I just bought the stock at 30.23, bought the 29 put and sold the 31 call, if the stock was above 31, I would have made 4.3% roughly. It was about 4.1% in 7 days. And if it dropped down below 29, I was only risking about $1.22, roughly the same 4%. Okay, so I didn't get any extra bang for the buck in this situation, and it might be because I didn't get enough premium, as Mark's mentioning, for that short call. Okay, but with the stock up to 32.51 on the 27th, it went up 5% after earnings and another 2%. We have a gain of $2.30 roughly on the stock. February 30 put went to 0. The 3rd of February 30 put went to a bid of 0 and ask of 2 cents. So we've got a loss of 99 cents. The stock moved up, so the 32 call was priced at 127. But this is a loss of 67 cents if we liquidated. So right now, with a move of 7%, if we liquidated the position at that time, paid $1.27 for the call, only got 1 cent back for the put, and sold the stock for $2.30 gain, we would have only made 64 cents or 2%. Now, if we held it for 50 days and kept it all the way out to March expiration next Friday, and it would get assigned, eBay's at about 33.20, 33.19 right now. We get assigned at 32, we make 4.5% for 50 days. Okay, so that would have been a successful trade of 4.5%. You know, you're averaging about 2.2%, a little bit more than 2.2% every 30 days or so, okay? Now, honestly though, if I'm expecting a 7% move or higher, I likely would have done a straddle, bought the 3rd of February, maybe cheap call and put. You know, the total cost would have been $2.20. It was $1.20 at the time for the 30 call, and we saw the 30 put was already at $1, so my cost would be $2.20. The profit at January 27th would have been 31 cents. We could have sold to close the February 3rd call for about $2.51, $2.52 and gotten about another cent. So we would have made 31, 32 cents profit, or 14% on the investment. If I did a strangle by buying the 3rd of February 29 put for 60 cents and the 31 call about 70, 75 cents, would have it cost about 130, 135. So we would have made a profit around 23 cents or 17.6%. Okay, so is your goal return? Is your goal monetary return versus percentage return? Are you scared about doing straddles or strangles shorter term when you expect a 6, 7, or 8% move because you're worried about a volatility collapse? Well, if you break it down to percentages, the straddle and strangles would have done better. Okay, break it down monetarily. You know, we saw originally that the liquidation of the collar would have been 64 cents, so it's higher monetary value, but we bought the stock outright, so we only would have made 2%. Now, we would have made 4.5%, double that, about $1.20, probably closer to about $1.40 if we hold it for the 50 days and let ourselves be assigned at expiration. Okay, now, of course, is it really better, worse, or just different? It's mostly just different. You know, straddles and stranglers offer less cost out of pocket, similar risk, but the benefit of the straddles or strangles, if you had a 10, 15, or 20% move, you get a much higher profit percentage-wise and monetarily on the straddle and strangle than you would on the reverse calendar or the reverse collar that you're looking at. However, if you did a longer-term straddle, back on eBay, if I bought, let's say I apologize, if I had bought an April or maybe even a June series, I would have paid probably closer to $6, maybe $5.50, maybe $7 for the straddle or the strangle. And I have more time on my side on the long options, so they're not decaying as much. There will be some volatility crush, but not a lot. But at the same time, I'm likely not going to realize a decent, I'm going to realize a profit, but it might not be as high as the shorter term ones. But I have infinite upside in both directions. So with a 15% move, I'd still make more on the April strangle than I would on the near-term reverse collar or reverse calendar spread, because it's still capped at one side or the other. The live leverage works both ways, right? That $6 or $7 I might have paid for a May straddle or strangle, if the stock doesn't move, I can lose all of it. Now, it's going to keep some of its time value, but if I did that shorter February series and paid $170 for that straddle, and the stock only moved, 0.5% or 1% because they were meh one way or the other, well, I run the risk of that short of a time frame in the volatility crush losing that whole $1.70. And if I wasn't careful and I did 10 contracts, I could be losing $1,700, where you're still only losing 2% of what you had invested. So remember, the live leverage works both ways. Another thought here is the fact that if the stock doesn't move, so in the eBay position, if the stock stayed right at 30.23, well, your put is going to go to a zero. It's going to go from that $1 to probably about 20 or 30 cents with 7 days left to expiration. All right, so you're going to lose a fair amount on that put. It's going to suffer the volatility crush. The farther out March call wouldn't have experienced as much volatility crush. And if we sold it for 80 cents or 70 cents, if the stock's still at 30.23 the day after earnings, it's still probably going to be worth 60 or 70 cents. I'm not going to get much time decay. I'm going to have to wait for the stock to move or another month or 20 days to pass before I can buy it back. The risks are the same, essentially, with all these strategies I'm mentioning, of course. The death zone we already saw with the, this type of reverse collar. The death zone is right in the middle. In order to be profitable on the straddles, on the strangles, on these types of reverse collars, or on the reverse calendar, you need that sudden movement of 5, 6, usually about 7% in order to make a reasonable profit of what you're expecting. And by the way, we looked at that straddle and strangle. This is where, let me show you. Sorry, there we go. This is typically what I expect, by the way, with a straddle and strangle, especially near term. We're not talking about a lot of money unless you do a lot of contracts. People talk about, oh, well, you can realize 20 or 30% gains on a strangle. Yeah, that's with a 15 or 20% move. How many stocks have you been tracking that have had earnings in the last cycle or the cycle before that moved more than 15%? Most of them are probably in that 4 to 5% range, and a few outliers in that 10 or 15%. And remember, the stocks that are poised to move the most because they've had poor performance or they've had previously poor earnings, and everyone's speculating on the new earnings, the volatility is going to be much higher. So you're going to pay a lot more to get in that strangle. You're going to need a lot more movement in order to profit. And it would be the same with the reverse calendar, because the option that you're buying is closest to the earnings date, so that put is going to suffer the most volatility crush on the position, not the call. Now, yeah, we've got a couple minutes here. I'm going to try to show UBNT really well from when their last earnings were. UBNT is one of the ones I had that dropped, and any of these strategies would have been successful. But real quick, I do want to mention, for what you're talking about, I don't know if I would use this strategy personally as an earnings play. I see the benefit of it. I see what you're trying to do, and I like it. It still is a capped gain to the upside. If there is a 15 to 20% move, you can let it get assigned and make that profit, but you're not taking the advantage of the infinite upside you get with a straddle or with a strangle. That's a long straddle or a long strangle, not a short. Never do a short straddle or strangle before earnings, okay, in my opinion. But in the sense of, if you're in a covered call right now and you have earnings coming up and your call's a little bit out of the money, I have nothing against buying a cheap put to protect it. Okay, I would actually advocate for that. That's a strategy, because I don't want to get caught with a 15% drop in the stock when I have the stock in the covered call and I'm looking at potentially a profit and then it tanks on me. I'd want that there. And buying the call back also to leave the upside open, okay? Okay, No, Mark, you're right. Mark says if the put was fully paid for by the call, why does it matter if the put loses value? It was essentially free. Yeah, but you're right. And if you receive it, but then you're just looking at the intrinsic gain up. Okay, so let's take a look at something here. Let me go over to this point, okay? And so let's go back to AEIS for a moment. I'm going to go into the custom spreads. Did everyone link over to PowerOptions here? Nope. Okay, here we go. Sorry, folks. There we go. All right. So the AEIS example here, it's going to look the same risk reward. The break-evens might adjust, but let's say we get into AEIS at 64.50 again. And, this only offers monthlies. So let's say we have somewhere in the next 2 or 3 weeks, we've got earnings coming out, and we're going to buy the at-the-money 65 put, really going to be about 255 or so, 250 if we go midpoint. We'll just use 250. Now, July is the only series available, so I only need 250, so we'll go with a 70. Okay? And again, just the way the math works, this is going to be a similar position in that reverse calendar. Okay? Now, to break even, and this is at April expiration, not at July. Okay, at April expiration, you are talking about a max return of 8% if the stock's above $70 per share. And if the stock falls, you paid for the puts. So you've got this skew. I see what you mean. You've got more of a skew than that sort of straddle or strangle position. And you can make a profit to the downside. But again, to break even at April, based on your cost basis, you've lowered your cost basis down now. It's even at 64.50 of what you paid for the stock. The 65 put does kick in if the stock falls. If we go down, right before April expiration, if the stock goes to 60, let's see what that would look like. Okay, you'd still be at a loss of $34. Why? Well, because you paid $64.50 for the position. You've countered the gain and loss here by the long call that's further out in time, but you still have a cost basis of $64.50. Okay, so the put hasn't balanced out the loss in the stock yet. And this is, let's say earnings were at 4.2. So in 4.3, you'd expect that the put is going to essentially, have a gain of 513. I'm sorry, a gain of 263. But you've essentially given that back on the stock. And the call still has value. It didn't go to zero. It dropped from 250 to 97. But to liquidate, you still have to pay that. Okay? Now when it starts to drop further, that's when the call starts to drop more. So again, where's our break even at April expiration? It's at 58.32, 10% below the current stock price. Where's our upper break even? It's lower now. You're right, because you paid for it. So it's at 67.42. Okay? But again, I might get the same type of return. Let's say the stock did go to, $68 per share the day after earnings. We'd have a gain of $43. Okay, so the put's going down, but it still has some value. Sell to close that for 50. You got a 350 gain on the stock, but the call now is going to be worth more. Okay, so again, I'm not saying you're right or wrong. I'm saying this is a strategy I wouldn't necessarily do, in my opinion. Okay, the reason why, again, is that if I'm expecting a gain as much as 5 to 6% one direction or the other, maybe 7 to 8% one direction or the other, I'm evaluating more the long straddle or the long strangle rather than putting up 64.50. Now true, you're only risking 149 or 2.3%, but if I don't want to say this, I'm sorry, if I'm disciplined with my position sizing, I can make sure that whatever I pay in the strangle doesn't risk more than 2 or 3% of my total portfolio, and I have infinite upside risk, if the stock gaps up to 70, 75 or more. Would you still have a gain on this, let's say if the stock went up to $75 per share? If it moved a full 10 points, almost 20%, sure, you'd have a gain of 282 after earnings, but remember, your call's out to July. Why aren't you seeing this 8.3% that we see on the chart? That's because it's still retaining more than half of its time premium. Okay, at 769, stock's at 75, you sold the 70 call at 769, there's still $2.69 of time value out to July. You're not going to be able to buy it back cheaply. You now have to wait to July to realize close to this 8.3% gain. Okay, that time value is not going to decay until you get in the last 30 to 45 days of the position. Now, can I get 250? Well, this is a bad example, but let's look at where eBay is right now. We've already had earnings on it, but let's look at where, let me go back. I'm sorry, let me go to the chain on eBay real quick here to January 25th. Let's see if I can go back that far on my trial account. Okay, here's hoping. Hey, great. Okay, so back to January 25th. Let's go ahead and look at the chain. Here's our stock at 30.23. Earnings were coming out on the 26th. Let's go to February 3rd, and this is where I got that 30 strike put at about $1, 96 cents to $1, so we call it 98 cents or so, okay? Now, you wanted to go further out and higher in strike. Let's go the next week out. I need $1. There's the 30.50. That's the first one I saw. That's not enough upside room. So let's go out another week, February 17th. 30.50 again, not the 31. One more week. Let's go to February 24th. 30.50 covers it, but you're only giving yourself 30 cents of upside room. It's not going to be a good return. 31's not there. Okay, so on and on. Went out to March 17th on eBay, and here's where I saw the 31 at $1, but the 32 is about 60 to 65. So to pay for it, went out to April, still not there. And now, go to July. There we go. So let's say we gave yourself more room, Mark. We did the position by buying the 03 February call, February 30 put at $1. We paid for it by selling this July 33 call for $1.15. Okay, now let's go to the 27th, as we did before. All right, the 33, stock's not there yet, it's at 32.51, but it's at even price. Okay, my put went to 0, and you've got the $2 gain in the stock. Okay, but that's about about a 7% gain. But to liquidate, you'd sell the stock at 32.51, and now you have to buy this back at 115. So you really only made 31.40 or $1.20 on the position, which, by the way, if we go back, the $1.20 profit, or so, it was double of what we would have seen on the collar that I used, okay? But at the same time, that would have been a 4% gain. I could have done the same return by just doing a 2-week out standard collar on the position. So is it worth it to go that far out to do the position to have the lower risk? Well, I'm an advocate of lower risk, so I understand what you're doing and I can appreciate it. But as an earnings play, if you're disciplined with straddle and strangle, you get better benefit of the unlimited upside and downside. A lot of times you have to go further out, maybe 84, 90 days, 75 days to get the premium you want to cover the at-the-money long put because of the increased implied volatility. Well, that means that even if the stock falls, the drop in the price is not going to be as significant. You're still, if the stock fell to $28, this 33 call would probably still be worth about 40 or 50 cents right after the earnings. I only made about half of it back. Okay, so you're not going to see that go to 0 unless there's a major drop. And as we saw again with the profit and loss chart we were showing for that eBay position, you were only making about 1 or 2% to the downside if the stock really gapped down. Another reason I might tend to look for a straddle or strangle if you're expecting a 7%. Anytime I expect a 7 or 8% move on the earnings, I'm probably going to look at a straddle or strangle. I see what you're doing. You asked me to tell you my thoughts on this reverse collar. Those are my thoughts. Don't think it's the best earnings play that's available if you're expecting those kind of moves to where you see the profit. My concern is that to pay for an at-the-money near-term put that has an increased implied volatility and is going to be most affected by the volatility crush, you may be going 75, 80, 90 days out in time, which means that even with a 7 to 10% drop in the stock, you might only see a 50% decline on that option. You won't see the rest of that time value leak out until you get in the last 20 to 30 days. So is that return going to be worth it for you for holding on for maybe a 60-day period or a 50-day period? Whereas if I had a 7, 8% move in the stock, Maybe I go 2 expiration cycles past the earnings date with a straddle or strangle. I'm not realizing a higher monetary profit, but percentage-wise, I'm in the double-digit range instead of just maybe a 1.5% positive return to the downside if it really gaps down. Maybe, as we saw, again, an 8% return to the upside, but I would have had to have waited to July to realize that a day or two after earnings. If the stock gapped up, we saw it was to 70 or 72 on AEIS with a 70 call, we're only making about half of our expected gain. Reasonable return, still 4% or so, but you don't get that time decay in your favor if you have to go further out in time. Okay? So that's my subtle opinion. Any comments you have on that, Mark, please feel free to email them to me, and we'll discuss them later via email, or we'll discuss them, of course, in another presentation, open discussion forum presentation. And, of course, we can evaluate other examples as well, and I might do that next week if I have time. Not guaranteeing I'm going to have time next week. I have a lot going on next week as far as webinars and other projects go, but we'll see. Okay, so those are my thoughts on that, what I'd call a reverse collar. I appreciate what you're doing, and yes, you've got a very good limited risk right there in the middle, that even if the stock stagnates, you still have ways to manage it. But then it becomes tricky because that short call that's that far out, you're not going to get as much decay in your favor in those first couple of, in a week or two if the stock doesn't move. All right, Larry, if I do a married put that's more than a year out, 600 days out, what are the pros and cons? Okay, if you really want to put on a trade and walk away. Okay, well, I think, Larry, we've discussed this before. Let's say that I was going to open AEIS today. I'll just stay with it. It's a position that I'm in. It's had a good run the last 2 days. For those of you that have been following the position, it's not actually a great position. It's profitable. So yesterday, oh, I didn't. Okay. I actually had the 60 call and the 60 put on AEIS, and the stock moved up to 63 yesterday. It only offers 5-point strike differences, blah, blah, blah. So when it went to hit 63 yesterday, what did I do? I rolled the call from the 60 to the 65, which increased my return by 2%, and I rolled the put from the 60 to the 65, which allowed me to keep most of the upside return at 65 and lowered my risk down to 1.5%. Of course, I made that trade yesterday. So what happens today? The stock goes up $1.57, where it hasn't moved from $62 to $63 in 40 plus days. Now it decides to do that because I just sold the call at 65. Could have gotten $2 for it today instead of $1.50 yesterday. I'm sure that's the reason, right? That's the reason AIS went up, was because I sold the call. But, knock on wood there. But I'm going to stick with this position just to take a look. No, I'm not. I can't. My apologies. Now, let me try eBay. Perfect. All right, let's say I was getting into eBay today. Honestly, I'm in this one too, but honestly, if I was opening a married put, a radioactive trade on eBay, I'd most likely buy the stock today, of course, at the price of $33.13. I would likely go to the October, and I'm going to try the 35 put at $365. 2 strikes in. Yes, I'm paying 10% of the underlying stock. This gives me a low risk. I could have gone to the 34 at this point, but I don't know if the far out ones are going to offer a 34 single strikes, Larry, so I'm going to stick with the 35. So a low risk of only 4.8% for 224 days of insurance. Okay, so my October total investment of $36.78, risking 4.8% on the position, 224 days. Now, 2 months from now before earnings, I think earnings is on May 25th, I think the next earnings. So let's say around May 20th, let's just see what the stock would be if it does move up to 35. You know what, let's say April 13th. Let's go just a month out. Okay, let's go to April 13th. Okay, and so the expected gain here on 4/13, if the stock was at 35, would be about $72. All right, so it's about a 2% gain with the stock moving up probably about 4.5–5%. That's what we expect to make. Okay, so I've got a low risk. I'd cross at least 1 earnings, maybe 2, probably 2 when the cycle falls. I've got a 4.8% risk. I've got weekly options and others in between, so I've got several different right cycles I can use to knock down that risk. Now, let's go to 3/15. Let's go to January. 35 put. Now, this is one of the advantages of going further out in time. sorry, let me take, I'm sorry, I wanted to show something here, and again, I can't. Sorry if you guys see a button pull up here on the side. I apologize for that. Now you're going to see something unbelievable. All right, not going to worry about it right now. My apologies, okay? All right, so remember, the 224-day out option to October was about $360. I only pay under 50 cents more, about $410 for the 35 put out to January. Okay, so we call this $410. Oh. All right, so now my cost goes up to $37.23. My risk is 6% compared to 4.8%, but that's for the 300 and some odd days, okay? And it's a 6% risk. My cost goes up to $37.23, only about $50 more. So in this case, I'd be very tempted to go with the first January option. I think it gives me a little bit better than the October. Even though the cost is 50 cents higher, I'm going from October to January, so I'm gaining more time. And it's not linear. Okay, but let's go again. What would happen at $35? We got to pick the same time frame. April 13th. There we go. All right, so the gain would be slightly more, $79 in this case, if the stock was at 35. Based on Black-Scholes pricing models, everything's theoretical. So again, they're about the same. I'm paying 50 cents more, but again, for 90 days of extra protection, I would be leaning towards the January 2018 35 put right now in this position. But what about 679? 35 strike, 535 to 560. Definitely not double, which is a benefit. Okay, so we'll call it 550. Rough midpoint estimate. Risk goes up to 9.4%, but that's for 600 days. Okay? We've got a higher cost at $38.63, but as you all know, that break even to me only matters at expiration, and none of these positions are going to be held to expiration. Now, again, just as a fair comparison, what happens if the stock goes up to 35? And we could break this down and say, yeah, it's a 9.4% risk, but I'm 679 days out. So I could almost say that it's, 21 months or 22 months at 9% instead of 8 months at 4.8%. You can look at it that way as well. Okay, so 413, stock goes to 35. We have a theoretical gain of 92. So up front, the benefits look good. But where's the problem? Here are the pros. This is the pro. Whenever you go further out in time, as you know, Larry, you're paying less per day. The advantage of time is in your favor. There is usually a subtle lag with the farther out option. So if this suddenly gapped 3 points and went up to 36, I might see the October react faster than this January 2019. But it would catch up eventually. Okay, it just reacts a little bit more slowly. The risk is high up front, but we know that's for a longer term out. Okay, now, what happens if the stock moves up to 34.50? Okay, let's call it, it's at 33.13 now. Let's say in the next week or two it moves up to 34.50 as we expect, and then we sell the April 35 call. Now, stock's at 33.13, so the at the money 33 calls at about $1. So let's say the stock goes to 34.80, and we think about selling that 35 call for $1. Okay. Now, the only reason why I'm showing this is to show you that what might change now is the break-evens. So yeah, you still got a good break-even to the upside here, 40.70, and down here, you've lowered the risk to 7%. You've got a max profit of 5% at April expiration because it's going to retain more time. But let's keep that in play. And let's go back now to our October series with the 35 put at 365. And then if the stock moves up as we expect, now we've only got a risk of 2.2%, $78, so we've lowered that risk more, and the max profit is at 167 or 4.7%. Okay, remember what we just saw? Let me go back, see if it's still holding for us. Yeah, and this is at 189 or at 5%, but we still have a lot of time left on this position, but we didn't reduce the risk as much. So what I'm showing you, Larry, is the trade-off. Whoops, my apologies. The trade-off based on what your expectations are is, did you want a shorter-term profit and be able to cancel the risk faster with a lower cost? So if I'd expect eBay to have an 8, 10, or 12% move over the next 2 months, I'd focus on the October. If I'm more long-term growth, maybe you think it's like a Johnson & Johnson, a Microsoft, an IBM that's much slower growth, going out to January 2019 might be the better bet. Another advantage of January 2019 is if the stock doesn't do what you expect, and let's say it has a bad earnings and drops 5%, you could actually reduce your risk by selling to close your 35 January 2019 and coming into maybe the 32, or if it's available, a 33 strike to January 2019 or October. And you would actually lower the risk by moving the put in and down in strike, where usually that increases the risk. But because you had so much time still remaining, you should be able to maybe lower the risk. You'll have more options to move the put in time. You can't go further out in time. You can just go up in strike, of course. So that's another advantage. If it's not going your way, you could drastically cut down the risk by moving the put in. If I use the October, I could reduce the risk by moving the put into April, but now I only have 1.5 months remaining of protection. Not even 1 month remaining of protection on the position. So I have to admit that I'm getting out of it. Okay, so the pros and cons, you probably have already seen them, and you probably already talked to them about yourself. What are the pros and cons of going that far out in time? Higher cost, which shows a higher percentage at risk, but risk per day is lower. The cost per day is lower, the risk per day is lower. That's an advantage. So it looks like a con up front, but if you do the math, it's actually a pro. Buying the put that far out in time up front gives you more opportunities to move the put in if necessary, so it's a slight advantage, and still have a year of time, almost a year of time available to continue the trade. Risk reduction, if you're focused on risk reduction quickly and you want to get a bulletproof position, you're of course going to have to work harder to bulletproof that position that's further out in time, where here we cut that risk by more than half by being able to do the first cycle. Okay, and that's October, it's 224. The other January would be in between the two. Okay, you did lower your risk by 2.4% on the 2019. The risk would be reduced by about 2.6% on the 2018 and so forth. But, you know, what is your focus? Is your focus a shorter term return or longer term growth? Okay, so if the stock moves up 10 or 15% or maybe even 20%, we saw that, the moneyness is about the same. Okay, but percentage-wise, the gain on the October would be higher because you had less cost into it. You know, we put another, the January one was about a cost basis of $3,800. Okay, so it's about another 10% of what we'd have invested here in the October. That's just a balance if you try to liquidate it early. You might get a higher profit with the nearer term if the stock suddenly gapped up 10 or 15% than we would on the 2019. Okay, but again, if you're expecting slower growth and you want to stay in the trade for longer term, there's absolutely nothing wrong with going further out in time. All right. John, been very patient with me. Okay. And it's, I wouldn't say it's do that as well. I'm sorry, Larry, I didn't miss this. I missed a couple of your follow term questions. Okay. No, yeah, doing no real management, Larry. Yeah, it depends on what happens. And you can go up on the strike of the put, Larry, but remember you can't go further out in time because right now 2019 is going to be the farthest you see out in time for the next almost year and a half. Is that right? Yes. No. Yeah. Next year and 2 months. Mm-hmm. Yeah, so there's nothing wrong with that, Larry. You wouldn't have to pay attention to it as much, I admit it, but you just want to make sure that when you sell the calls and you do other things, it still matches. All right. John's been very patient. So John's questions are related to 2 of our signature tools. Okay, the signature tools tab here, we offer individual tools, some for certain strategies, some for market concepts. There's the volatility skew that's available. The market sentiment tool, which is the 13 broad-based indicators Ernie put together and setting the fences around them. The spread chain tool for evaluating credit spreads and parity trades using midpoint. Long option finder finds the best long call available based on your expectation. The stock repair tool, that's great to repair a stock that's fallen in price using ratio call spreads. Stock insurance, lock in gains on a stock. If you have a stock that's up in price, this will show you which puts you can buy at a bulletproof position. And the strike of pain. John's two questions are on the most obscure ones that many of you are probably saying, what is that noise? Yay! Sorry, sorry folks. There we go. I found my pen. Okay. So the two more obscure ones are the strike of pain and the volatility skew. And that's what John's asking about. All right. Our strike of pain tool. This tool is based off of the Max Pain concepts. Forget the name. BCA Software developed the Max Pain rule. So back in kind of the 80s, late 80s, mid 80s, into the 90s, floor traders had this tendency to notice that stocks that had options would gravitate towards a certain strike price at their expiration. So eBay is at 33. You know, if it didn't offer dollar strikes, it just had the 32.5, the 35 normal strikes instead of these 50-cent strike differences with all the weeklies. Well, let's say we're heading to March expiration, we had a 32.5 and a 35. What they'd notice is that day it would start to gravitate towards the 35 strike or the 32.50. Okay, but a lot of stocks that had options tended to do that. And they called it the Max Pain effect. And originally, a lot of investors thought it was just whichever options had the most open interest. That's not entirely true. Okay? The Max Pain calculation does is it takes into account if the stock's at a certain price, let's say eBay's at 35, then it calculates the monetary value of every option that's in the money. So the 32.5 strike call, the 30 call, the 32.5 would be 250 in the money times its open interest. And then the 30 strike call would be 5 points in the money times its open interest and everything underneath of it. So if the stock is at 32.50, it's calculating the monetary value for everything below it based on open interest and how much in the money it would be, as well as the puts, where the 37.5 would be 2.5 points in the money times its open interest and everything there. So at 35, it's looking at the monetary value sort of all the in the money options. Let's take a look at eBay. Okay, and I'm going to go March 17th, standard expiration next week. Okay, now, stock's at 33.13, and it does show me that the 33 strike has the most pain value. Okay, the lowest pain value. That means it's the lowest monetary value. So what it's telling me is that based on all the open interest here, and you can see all the open interest down here, yes, it is the highest strike. It is the strike with the highest open interest, but what it's also saying is these options here that are in the money, remember if the stock's at 33, all of my puts here times their open interest and all of my in the money value for my calls here times their open interest, this what calculates the pain value. And it's lowest here at 33. So the idea is the stock is going to gravitate towards $33 at expiration, March 17th. Okay? What the Max Pain essentially is saying is this is the price where option sellers make the most money and option buyers lose the most money. Okay? That's what it means by the pain value. Is it reliable? I don't know. I used to do statistics on this, but honestly, when the weekly series started coming out and these 50 strike differences and dollar strike differences started coming out, it honestly lost a lot of reliability. I mean, there's so little wiggle room between 32.50 and 33 if you're trying to use this tool. If I use this tool and I say next week I think the stock's going to be trading right at 33, and I think the stock was going to be right at 33, maybe I'll do a bear call by selling the 33 and buying the 35, or selling a 33 put and buying the 31. So I can maximize the at-the-money time value not only, but also maximize if a stock stays right at about 33, I might have to pay a little bit for that short put or short call, or it might expire. Or you might do an iron butterfly. Okay? But there's a big difference in this. If I sold the 33 and I might only get 30 or 40 cents, even on an iron butterfly, and the stock's actually at 32.50. That is a loss, because I'm going to have to pay 50 cents to buy that short put back. But it's such little wiggle room with these 50-cent and dollar strike differences. In reality, the strike of pain is only reliable a few days away to expiration, and I would not say it would be reliable at all with anything that's offering 50-cent strike differences when you get closer. John says TLT. Okay, so current price is at 117. Well, for our 317 expiration, strike of pain is actually at 122. You know, am I going to, do a bull put now by selling the 122 and buying the 120 because I think the stock's going to move up to 122 based on the strike of pain? Absolutely not. If I'm doing a bull put because I'm bullish on TLT, I'm still going out of the money. And if I'm doing a bear call spread, well, I might sell a 122, but it's going to match my criteria. Okay. This tool, in some of the research I did 6 or 7 years ago, I think the percentage win rate was 58% of the time it was right. Probably equal to, I don't want to say Bollinger Bands, but probably equal to like support and resistance and other trend lines, just drawing them on a chart. And what I mean by 58% success rate is that 58% of the time on a group of 100 stocks that I ran over a course of a 3 or 4 month period were 58% of the time was at or within 1.5 to 2% of its strike of pain 58% of the time. But at that time, again, there weren't 50-cent strike differences. There weren't 450 stocks that offered weekly options and 50-cent strike differences. So on a $60 stock, 1 or 2%, if I thought the strike of pain was at 60, okay, but it was actually at 59.70, or I'm sorry, 59.40 or 59.30, that's within 1%. Now, if I'd sold a 60 put, I'd have to buy it back. But that time with standard expiration and not dealing with 50-cent strike differences, I would have maybe gotten $2 for a standard expiration 60 put on a stock trading around $60. So paying 60 cents back for it would still be a profit of 140 for me. Whereas here, if I sold the 60 strike put based on the strike of pain, let's say the stock was even at 61, it said it was going to gravitate towards 60. I sell the 60 put based on the strike of pain, on the stock drops to 59.40. Well, if it has 50-cent strike differences, I probably only got 50 or 60 cents for it, and it's going to cost me that much to buy it back with the weekly options and 50-cent strike differences, okay? And that's what I'd see with TLT. I mean, I wouldn't say that, hey, I think the stock's going to 122, so I'm going to buy a 117 call right now at the money, or I'm going to do a bull put spread at the 122, 120, that's 3 points in the money, thinking the stock's going to go up there, because I'm still kind of trading against myself, all right, with an in-the-money bull put spread. Now, the volatility skew is your standard kind of skew range, all right? You just put in a stock symbol here. We can use AAPL, and you can choose to look at a date, the strike skew for a given expiration date, or a time skew. Most investors use the time skew, all right? But let's go to the expiration date. What this is just showing me is it a volatility skew or a volatility smile, all right? And this one looks more like a skew here. So the low point is the at-the-money strike. What does this really mean? Honestly, it depends on who you talk to. We put this up based on a customer's request for an implied volatility skew. Some investors would look at this and say, oh, the higher implied volatility is to the deeper out of the money, and it doesn't really come back up unless you go really far out of the money. This is on the calls on the blue side, of course. Let me take it here. So some investors might say this means that this stock will likely fall to the higher implied volatilities in the next 7 days. Others would say, no, this kind of means that it's stable, and more than anything, it's likely to move up. There are people who take this as a contrarian one. There are people who take this as a direct indicator. And of course, you also want to apply it to the puts to tell you what are the puts saying and what are the calls. But again, this is why most investors use time skew. So I'll go Apple, which is at 139.14. I'm actually going to go to the 139 strike instead of the 140. And it shows me the volatility markers for all the expiration dates going out in time. Okay? So it goes up to about 5 months, 5 expiration cycles, and we see the implied volatility is increasing as we go further out. So the time volatility is not a skew or a smile. Let me think of something else. Let's try that ridiculous stock I'm in right now. UBNT. He's at the 50 strike. Yeah, see, this is pretty much the same. The time strike, you usually expect this. Who's using this tool? Well, honestly, the investor who's probably using this tool is someone who's interested in calendar spreads, and they actually want to see the reverse, don't they? They want to see that if they sold the April call, you know, the at-the-money call has a volatility here of 0.30, whereas the September and the January are up in the 0.4, and even June is 0.38. Okay, so this is not what someone wants who's doing a calendar spread. They want this reversed. They want the implied volatility to be higher here. Of course, I would just run a search for calendar spreads that have the implied volatility I want. Let me try something else here. J&J, is that going to give me one? 127 strike? No, most of them are about the same, aren't they? These are pretty even going further out. It does look like the farther out options have an increased implied volatility, except for on the put side. Now, there's a calendar there for 324 versus 331. That might be interesting there depending on the strikes and the volatility. Okay, but again, what are investors looking for? Again, they're still looking for that smile or that skew, and however you evaluate the skew or the smile is how you tend to do that. So let's go to March 17th for Johnson & Johnson. It's probably going to be, this one is more of a smile, isn't it? Slightly more of a smile than we saw on Apple, because Apple sort of dipped way down, but then it didn't really recover too much. This is more of the volatility smile for a standard expiration for 1 week out. And then if we go 2 weeks out, we still see sort of that volatility smile where it's trying to be a smile in that position. Okay, so what does that mean again? Again, it depends on who you talk to. I don't have a direct answer for you on this one. It's mostly used by calendar spread traders. Some investors who are maybe trying to do a near-month spread, a volatility spread, may use this for the strike skew in the near month, looking for that volatility smile, projecting on whether the stock would go one direction or the other. I honestly have not found it that reliable. And it all depends on what events are coming up between now and March 31st as well. I think Johnson & Johnson in this case already passed its earnings. That's not a concern. But you are seeing here more of a smile on Johnson & Johnson in the IV than you saw in Apple when we first pulled that up as well. Okay, so there's a little bit of discussion there on the volatility skew and on the max pain or the strike of pain. Whoops, wanted to go back to the Signature Tools main menu. There's a couple of videos here on these as well, and I have a full video, something that might interest you later, John, I apologize, in the free webinars section. Right here from September 28, 2016 is a full hour presentation on the sentiment tools. I'm sorry, the signature tools that we have there. So the market sentiment, stock insurance, how to repair stock, long option finder, the spread chain, and of course we did throw in, of course, there is mention in there of the other two as well, the max pain and the volatility skew, if I'm not mistaken. And another resource here, my apologies, in the options concept section of the archive webinar, there's a webinar here on implied volatility, a double-edged sword. I don't go into that skew tool at all on this webinar, but we do discuss, you know, what do I mean by the double-edged sword? You hear a lot of people say that, oh, well, if you're selling premium, you need to trade into higher implied volatility. Well, not necessarily. Yeah, it gives you a better premium, but why does it have a higher implied volatility? It's because something's on the horizon or something has happened, and there's fear on that particular stock that could cause it to fluctuate. That's not something I want to do in a covered call or a naked put. You say, oh, well, it's good to do a bull put credit spread because you get a higher premium. Well, remember, if the underlying options 1 month out or 2 weeks out have an increased implied volatility for the options you're selling, the options you're buying in that same expiration to complete the spread are also inflated. So you're not getting much of a trade-off there between the two. So a lot of the strategies investors use for selling premium are relying on the stock not moving or being neutral to directional, neutral to bullish and neutral to bearish, and that's not necessarily you'd want to have a stock with a high implied volatility because you don't want the stock to really swing against you. Now, if it swings in your direction, excellent, you're in a better position. But if it doesn't, well, you didn't really protect yourself. All right, well, ladies and gentlemen, it's 5:33 p.m. Eastern Time. We're just a little bit past. I don't see any other questions that came in. I missed one or two of Larry's comments, unfortunately, when we were kind of reviewed those, but when I was doing the discussion, I didn't see his other comments as we were talking about the far out in time married put positions versus the near term as well. But of course, we still have, it's only 5:33. If anyone has any last minute questions, feel free to throw them in. I want to remind everyone, those of you that are here, if you have not tested PowerOptions yet, or maybe you had a trial a year or two ago and you're thinking about trying it again, just go to PowerOp.com, put in your first name, last name, and email address, and you'll be able to start a 14-day free trial with no credit card information as well. So you can have access to the tools we looked at today for 14 days. And our subscription levels following that, we do have an end-of-day service. It gives you access to all of the search tools for all 23 different strategies. We looked at the custom spread tool today, but the portfolio tool for tracking, the signature tools we looked at as well, but only updates end of day. That's $40 per month. The delayed service is one of the most popular probably services, most subscribers. It's 15 to 20 minute delayed data, and that's $60 per month. And of course, the historical service, where you have full access to our historical testing. We looked a little bit at the historical chain today when looking at those back prices on eBay for the premiums when we were talking about the reverse collar around earnings. The actual full historical data goes back to April 2006. So it's over 10 years of historical options data for all optionable stocks at the time and all those given years. Now the 20-minute delayed plus historical is $100 per month. We do offer real time that's $120. So every time you refresh the page, you're getting the numbers and calculations at that very instant. The standard real time does not include the back testing, but the full service at $160 will include everything, real time, historical, and access to the programmer's interface, the API, so you can interact with the data directly. Now, if you want to see some other educational information, remember, check out the blog, blog.powerop.com. And of course, we showed a moment ago, you can go to that webinars page. It's powerop.com/webinars.asp. You can look it through our archived webinars at any time. Or you can also go to our YouTube channel. If you just go to youtube.com, do a search for Power Options, all one word, you'll be able to link to our channel, and most of our webinars are archived as well. Speaking of which, of course, I did record today's presentation. I'm going to be honest with everyone. I missed the first 4 or 5 minutes. That's why earlier in the conversation when we were addressing Mark's question, I went back to look at that reverse collar again in the profit and loss chart. So we missed maybe the first 5 minutes of that discussion, but I think it's going to be okay. But everything else has been recorded. I'll post that archive later on this weekend, and you can go to powerop.com/webinars.asp. And the requested topics section is where we have the last month of open discussion and open forum presentations archived for you. Now, if you think I haven't seen any other questions come in, David, thank you for joining me. I'm glad you enjoyed today's presentation. Larry says, great job. Thanks for these seminars. Larry, thank you for your question. It's always a great question to ask. I hope I give you some useful information on that. There's nothing wrong with going 600, 700 days out in time with the married put. There's nothing wrong with going 220 days. It does depend on your expectation. And of course, if you want to spend less time watching it, I agree with you 100%. Maybe you want to go further out in time so you're not worried about that time decay happening in the first 1, 2, or 3 months as well. Okay? All right. So I appreciate that. Of course, if you think of a question later on, I'm sorry, send me an email to support@powerup.com. If you have questions about radioactive trading, send it to support@radioactivetrading.com. And Sam says, I have to say, I'm sorry, I'm not laughing at you, I'm laughing with you. This was my exact thought 4 days ago. Sam's question, any ideas on Snapchat when the options are starting from next week? Very volatile, still never traded Snapchat yet. I'm 40 years old, 41 years old. I'm 40 years old. I'll be 41 in a month. Greg Zarenner, Ernie's son, who's the CEO of PowerOptions, we're the same age. And when I saw the Snapchat earnings and I saw what happened, the IPO, not the earnings, the IPO, and then it pulled back a little bit after that. Of course, I knew it was going to be volatile. I was waiting to see when the options were coming out because honestly, I looked at that thing like I saw Twitter, where it jumped out. I don't know what they have for advertising. I don't know what they have for revenue. I was really interested in buying puts on Snapchat as soon as it came out or as soon as the puts were available. But I agree with you, Sam. I know that when they do come out, I guess they're coming out next week or they're coming out soon, but when they do come out, they're going to be high priced because of the volatility and the unexpected. I can't give trading advice, but my thought was I have to do more research. I have not done my due diligence, and just the way that Twitter behaved when it was that big thing and everyone was excited, and then it just kind of fell and fell and fell and fell. Knock on wood. I'll let you guys know. I might do a straddle on it or a strangle that's a couple months out in time, at least probably 3 or 4 months out in time when that comes out, just because I just don't know what they're offering. I know what it is. I know what it does. My daughter plays with it all the time. She loves it. But where's the revenue? What is their business model? What is their real thing other than having a little fun thing for younger generations, kids, and people to play with and take neat pictures with and change them? What's the far out business plan? What are they going to expand to? What is their revenue? Because I don't even see advertising on it unless I'm missing it personally. So yeah, and Sam has the same thoughts. I see Twitter and FB had the same behavior. Yep, and we remember what happened with Twitter 3 or 4 months after, and the next 2 earnings cycles on Twitter after its IPO and what happened there. So maybe it's a good example. We'll have to see, but yeah, I'm in the same boat as you, Sam. I want to see when those options are available on Snapchat, and I want to see how bad the volatility is and what makes sense as any kind of play, as a straddle, strangle, maybe a reverse collar. Who knows? I mean, I don't know when their first earnings cycle is, but maybe a reverse collar might be pretty good. You could do that in your IRA most likely too, remember, because that's one thing I forgot to mention on Mark's comments. If you're in a restricted account where they might let you buy calls or buy puts, but if they tell you they just allow you to buy calls, buy puts, and sell covered calls, you won't be able to do spreads. They wouldn't let you do a calendar spread, for example, sell a call against it. You could still maybe do a straddle or strangle, but if you're more comfortable with that lower percent risk that Mark showed us with that reverse collar, that 2, 3, maybe 4% risk on the reverse collar, you could still kind of mimic a strangle in the short term right around an earnings event. So if you expect a big drop or you're worried about a big drop, it's an idea. And of course, remember, if you are trading covered calls, you have stocks coming up to earnings, there's nothing wrong with adding a cheap put against it. Hey, if you only spend 40 or 50 cents on it and the stock moves up and you were wrong, well, when you roll your call, you'll probably increase your percentage return from maybe about 3% we were in the call to rolling higher to 4.5%. That's probably going to cover the 40 cents you paid just in case the stock collapses and drops 10%. And the put would have hedged you on that and you would have been good. All right. All right, folks, have a fantastic weekend. I look forward to seeing you possibly online sometime next week at one of our upcoming webinars as well. Next week, before we head into standard March expiration and St. Patrick's Day. That's going to be a lot of fun. Should be a good time. But we'll see what happens in standard expiration next week, next Friday. Hopefully I'll see you guys there. Have a great weekend. Good night.